Good afternoon. My name's Larry Ray. I'm the President and CEO of American Manganese, Inc. I'm here to tell you today that American Manganese could possibly bring in the lowest cost electrolytic manganese metal mine in North America. It'll be the first one in the past few decades. What is manganese? Well, you can't have a steel industry without manganese. If you don't have manganese, you don't have steel. If you don't have steel, the world stops. North America has no manganese. We depend on our neighbors and other countries to import our manganese, and it just doesn't make any sense we don't exploit the resources in our own country. So I'm here to tell you that we are moving ahead with the feasibility study, we're moving ahead with the environmental studies, and we're moving ahead with a massive drill program in order to build the American Manganese, Inc. into the first primary electrolytic manganese producer in the United States. Please visit our website at americanmanganeseinc.com or call us at 604-531-9639. Thank you.
Welcome back to the Money and Wealth Show. I'm Sterling Fox in conversation in White Rock with our special guest this week, Michael Levy. Michael, you talked in our opening segment about you would have to interpret it as increased confidence from the business community in Canada. It was in the papers this week. Businesses are expected to spend more, which makes the economy grow. What's the reason for this sudden boost or burst of confidence from the business folks who've been holding their cash back?
Well, they have been. They are sitting on piles and piles of cash because they also are afraid of another downturn and they don't want to be caught cash short.
Okay.
Now, they have to take this cash, though, and go out and invest it in equipment, manufacturing equipment, invest it in renovations, invest it in training and skills, because they have to meet the demand of what the consumers are now saying, we're buying. That's proven by GDP growth. Well, you cannot not produce if consumers are buying, but you also have to have the confidence that the economies are going to keep expanding, because once you start moving out and spending your own money, you just don't turn it off overnight.
Right.
And they don't want to get caught with huge inventories like they did in the fall of 2008. They don't want to get caught with too many employees. So reticent to spend, but knowing they have to if they want to keep the business expansion going. And guess what? That's what they're doing for their shareholders. You and me is expanding their business so they can pay out the profits in the form of dividends, so they can make money, so we all make money. So what they're doing is they're expanding and they're then going to spend. But the reason they're spending is because we consumers are more confident and we're spending.
Might some of that business spending translate into jobs? There are still lots of Canadians looking for work.
Oh, there absolutely are, and not as much as what there were. I mean,
True.
We are back now to just about fall 2008 employment levels. Now, that's a bit of a false number, because what you look at is the unemployment level and say it's about the same. But then it begs the question, how many people have come off the employment rolls? Because when you actively are not looking for work, you are not included in the statistic as being unemployed.
Right.
All
Even
right?
though you still are.
Even though you still are. You're
Right.
on welfare, you're on some sort of social assistance, families taking care of you, whatever it is. So that figure belies really exactly what's going on. But yes, there will be more jobs. And as I say, the unemployment numbers or employment numbers of the week before last, I mean, they surprised everybody. And I mean, as well they should have. They were fabulous numbers. If we keep expanding business, then our employment numbers are going to get even better, but albeit at a much slower level, because we had this jump in employment over the last 6 or 8 months that basically unparalleled in the last 3 or 4 years as far as the rate of change. So that does have to level off somewhat.
Here we are halfway through the summer of 2010, halfway through the calendar year. Michael, You've talked about some pretty positive indicators that have been received in the past few days, and second quarter earnings are now starting to be reported, that sort of thing. What could be the fly in the ointment? What could develop that would break this pattern, this fragile pattern of growth?
Well, let's start in Europe, Sterling. Sovereign debt is a huge problem. Now, we don't think about that here because, well, what's Greece's debt got to do with us here in the lower mainland of British Columbia or Vancouver Island? Or what's going on in the Netherlands or what's going on in England? Well, we are so much a global community that if one of the sovereign nations of Europe defaults on their debt, that sends a debt shock throughout the world. What do I mean? When we started in this recession, in this down move, in this pullback, in this near depression, if you will, in the fall of 2008, credit markets seized. Nobody could borrow any money.
True.
And our rates went flying up. Banks were reticent to loan to banks. So if you got a default in Europe, that default in Europe could translate into a situation here in North America where credit tightens up.
What do you say to those people, though, who look at this global picture that you've just identified so well and say, look, if a country like Greece can't afford to pay its way, it should default. It should be allowed to go broke. What would that do?
Well, first of all, Sterling, the banks that have loaned Greece the money have then again to write off those loans. And that's why you've got Germany, the European nations, the IMF, they're all involved in making sure Greece stays solvent, because if they go, the tens and possibly hundreds of billions of dollars that they owe to European banks mainly
vanishes.
Default.
Right.
Banks get their back to the wall. Government's there to bail out the big ones because they're too big to fail. So it has a domino effect worldwide. Now, that's number one of precarious things that are on the radar. Number two is the U.S.
Yeah.
U.S. debt, the deficit that Obama's running out, and the fact that they don't want to spend any more on stimulus right now. Well, this is going back to the model of the 80s. And the model of the 80s, the model of the 30s, when the banks stopped loaning out money and they started to raise interest rates. We had the Great Depression.
Yeah.
We're starting to get a bit of that psychology now. And Bernanke, who's supposed to be the student of the Depression, is now talking about tightening up. Now, not right now, not raising rates right now, but not affecting any more stimulus. The Obama administration not affecting any more stimulus. It's a real delicate balance. Do we give stimulus, print more money, take on more debt, or do we cut back and maybe not have an inflationary scenario, let business fend for itself, let consumers fend for themselves, and then we go right back to what I was talking about, is where are we going? We really don't have any definitive trend. The trend has to develop.
The waters are indeed murky at this halfway point through 2010. Our special guest here on the Money and Wealth Show this week is broadcaster and financial commentator Michael Levy. Please stay with us. There's more.
Good afternoon. My name is Larry Ray. I'm the president and CEO of Gold Ray Resources Corp., a company that trades on the TSX Venture Exchange and has the majority of its operations in China. We are currently developing a resource there with limited production at this time. Our goal is to increase this production up to about 1,200 to 1,500 tons per day. And to do that, we are negotiating with several Chinese companies, one of which will become our partner either directly into the company or into the project, which will allow us to move the project up to the desired tonnage. For further information, please visit our website at goldray.com or phone 604-531-9639.